Oh, hello. Welcome to another episode of LOTEK Wealth. Today, I discuss the economic principles of GameStop, brought to you by einfachman. I'm by no means an expert, but I like to absorb everything I can and explain it until it's rock solid. In healthcare, we do make everyone teachable. Just sharing, not medical advice. Check me if I need it. I crave attention, and from time to time, do need to put time out to drink water to compress my check. No, you can read. Well, maybe you can't. Sometimes my jacked teeth get in the way of obscuring my vision, so I will be reading the synopsis and zipping through some of the main points that I think we all need to hear over and over, especially you in the back. GameStop's one share price can reach the millions. Bears make money, bulls make money, and pigs get slaughtered, but what about apes? The words of einfachman. GME is a safe haven asset with strong fundamentals and a demand that will only be increasing post-split. The economic factors associated with GME will inevitably beget MOASS and ultimately pave the way for a potential GME price per share in the millions. That is once short hedge funds do reach critical margin call and they have to cover 200% plus borrowed shares. That was butter. Here's the bread. The economic principles of GameStop by einfachman. First cool graph. Unlike the general model, there is no shortage of shares. There is a shortage of real shares, but not synthetics. Short hedge funds can combine covered calls and married puts to create a synthetic share. See, simple but smart money. Infinite supply, right? Better keep those lights on. Fuddy-da-da-da-dee. Computer share accounts have only been increasing the entire year. Same with DRS shares. Since September 2021, apes have been registering 16 million shares. Supply down. Yet instead of price up, along with DRS rates increasing, it has steadily been going down in the long term. This, according to einfachman, is because of short hedge fund price suppression and because their critical margin levels have continued to slowly decrease over time, like the ceiling, shrinking below their heads. Big brain math formula for supply and demand: perfectly inelastic demand, daily DRSing, and relatively inelastic supply, limited float, relatively inelastic as it's being obstinately held, as well as directly registered. When short hedge fund margin call does happen, no matter how high price goes, demand stays the same because there are shares that must be bought back, regardless of the price. Look at Bitcoin's 100 million% increase based off of inelastic supply and increasing FOMO. They didn't even have 200+% share short interest. It's impossible on blockchain. A GME price in the millions is more than possible due to the geometric mean as well as synthetic shares. Looking at this bell curve, you see how there's a small early majority and then there's the major meat before it hits the peak. Yes, this is exponential growth. And look at the formula below. Geometric mean measures the compounding effect of numbers. Simply put, that is exponential growth. Quick side note, exponential growth is more than linear, where you got linear is 1 + 1, something like that. Then you got logarithmic, which is 1 times 10, and then you just times 10, you get 100, and then you get another 10, and that's 1,000. But exponential, every time you multiply it by itself again. So you got 10 times 10, you got 100, now you got 100 times 100, and then that's what, 10,000 or something like that. You see what I'm saying? That's exponential. Thought I'd explain, because exponential may not be the most familiar term with everybody. Inelastic supply meeting an inelastic demand. You got the people who will paper hand 50,000 to 100,000 per share price. They will not make an effect on the peak. They will leave early. They will miss it. And that's okay. It'll happen. That is just naturally that happens in the bell curve. But those who hang on from 100,000 to 100 million will see that price increase unbelievably. And then looking at the bell curve, you can see how much actually the DTCC will have to pay out in it versus closer to more like $5 to $8 trillion versus their $63 trillion insured. So yeah, there's money to pay the tendies in the bank. It's just that you gotta make sure that you're prepared mentally to hold on to those phone number prices, as they are very much possible due to this geometric mean of exponential growth. Again, not financial advice. It's just math. And the stock split dividend is devastating. There's a limit to borrowable shares. There's a limit to creation of synthetics. Nobody knows what it is, but there is a limit. Otherwise, it would have been bankrupt a long time ago. So when this happens, when the split happens, we don't know exactly what the brokers will do, but einfachman offers one of three or a combo of these options. Brokers gave IOUs instead of dividends. Short hedge funds use some sort of legal loophole that he wasn't aware of, or short hedge funds come up with a fraction of necessary synthetics to substitute the dividends and got help from the brokers, and other loopholes take care of the rest. Now, this, again, is a death sentence for the brokers. Providing IOUs themselves guarantees bankruptcy, and unless they're okay with a self-destruct button like Voltorb, they're not going to press that button. These massive brokerages that hold and manage trillions of dollars of money won't put themselves at risk of being entirely liquidated from one of the dumbest bets of all time. Ultimately, that doesn't matter, because a lower entry point to lock the float also means a lower critical margin level. Fundamentals einfachman goes over for the naysayers who say that GME will never make a profit. Einfachman uses the production function to explain their analysis, called the Cobb-Douglas production function. The Cobb-Douglas production function is used to represent the technological relationship between inputs and outputs. It's commonly used in the manufacturing industry, but has also been applied to a variety of companies. In the case for GameStop, this quantitative model can work by substituting the correct inputs. For instance, higher capital should yield higher output productivity, and with that comes higher profit margins. The ratio of capital to productivity is not 1-to-1, as we must take into account diminishing marginal returns, which the Cobb-Douglas production function does an excellent job at taking into account. Lots of quant, not definitive, but bigly if true, and it comes out to basically say May 2020 to May 2021, if following the same productivity, increase the productivity up until April 2023. Funny enough, the estimated month all shares will be locked up and DRS'd, will continue to increase in a productivity level of like 98.7%, which means they're going to have two GameStops for the price of one. Again, they're going to just continue to be productive at this rate. And biggest thing to note about these fundamentals is they do not maybe purposefully take into account the NFT marketplace, which, using OpenSea's higher gas fees, security vulnerabilities as an example, shows that $13 billion market cap compared to GameStop's $10 million market cap. And this is before this and this, but probably nothing. Back to supply and demand. GME economics. You got money times the velocity of which equals the price and the yield, or the aggregate output, also known as the real GDP. So let's think about $9 trillion print out, lent out at zero rate and pumped directly into the markets. It makes inflation, so we raise the rates and it fixes inflation. Yeah? Look at this graph. Wrong. The extent of quantitative easing, this is according to einfachman, from the Fed printing trillions of dollars as a stock dilution. Add in the current state of the market, extreme measures would have to be taken to lower the high inflation rates. The current rate hikes have not been enough. And now where does GameStop come into play? Unlike the dollar, GameStop has a cap of about 76 million outstanding shares, 304 million accounting post-split. Not considering the fact that GameStop has virtually no debt and a solid $1 billion cash on hand, I see no probability of dilution in the future. Hence, if the US dollar is being creatively actively diluted, but GME won't be in the foreseeable future. GME is a safeguard against US dollar deflation. Yes, there are synthetic GME shares floating around, but they must be bought back. For this reason, GME is not only a safe haven against inflation, but a generational wealth-creating machine due to the inevitable MOASS upon the closing of synthetics and ultimately all short positions. Take a look at this critical margin level. And although the market can create unprecedented troughs, GME can't. There's a hard limit to how much GME can drop. If GME drops to critical float levels, the float will get locked in a few months maximum, if not weeks. Regardless of what happens, GME is the biggest safe haven asset during a market crash. The crypto market will crash along with the stock market, as hedge funds have been and are still heavily invested in Bitcoin, altcoins. The primary reason the major cryptocurrencies generally move in tandem, because they're all put in these little baskets, like the ETFs, like the meme baskets. Crypto will not be safe during a market crash. Neither real estate, neither will commodities. So GME is not only shielded from inflation, but also a market crash. Regardless of how the stock market crash plays out, every outcome leads to GME being on top and MOASS inevitably initiating. I've learned one, I've done one, and now it's your turn to teach one, okay? If you're interested, continue to share, like, follow, subscribe, get involved in understanding what inflation is, because it's coming for you. Get ripped. Love you guys.